Hello, I'm Alessandro Scopelliti. I'm an assistant professor of finance at KU Leuven, and today I will talk about bank credit and market-based finance for corporations. The relation and, to some extent, the complementarity between bank credit and market-based finance for corporations has been at the center of an important academic and policy debate, given the strong reliance of firms, and in particular small and medium enterprises, on bank credit. Particularly in Europe, firms, and especially SMEs, encounter some difficulties in getting market-based finance for several reasons. For economic reasons, because of larger informational asymmetries, for regulatory factors, because of possible restrictions set by corporate or tax law, and also for investor protection considerations. But there is indeed a rationale to promote capital markets finance also for SMEs. Firstly, because excessive reliance on bank funding may somehow increase the vulnerability of these firms, particularly when banks might restrict credit, and also because the diversification of funding sources could help companies in improving their financing condition. But while in the US there are well-established capital markets, in Europe fewer companies are publicly listed in the stock markets, and also few of them issue debt securities. Now, there have been some initiatives undertaken at the national level to promote the issuance of bonds also by smaller firms. But we do still see some financial fragmentation in the sense that corporate bond markets are largely nationally segmented. And to address this, the EU Commission has launched a plan for the Capital Markets Union. That was already in 2015, it was revised in 2020, and one of the key objectives is to support economic recovery by making financing more accessible to European companies, for instance, by supporting access to public markets. Now, considering these financing needs of firms, it is important to assess the effect of recent policy initiatives which have been undertaken in the last years, also to draw conclusions for future policy design. And in a recent study with Steven Ongina from the University of Zurich, Sara Pinoli and Paola Rossi from Bank of Italy, we studied the effect of the use of market-based finance by unlisted firms via the first issuance of bonds on corporate financing condition and performance. And for this purpose, we exploit a regulatory reform which has been introduced in Italy starting from 2012 for the introduction of the so-called mini bonds. This reform was aimed at improving the access to debt capital markets for unlisted firms by removing the previous quantitative restriction for the issuance of bonds by unlisted firms under the conditions that these bonds were to be negotiated in regulated markets or in multilateral trading platform, but open only to professional investors. And also, the Italian Stock Exchange created a dedicated segment called Extra Mot Pro Free. We study the effects of the first issuance of these bonds thanks to this reform using a combination of granular data sources, including the credit register from Bank of Italy for loan amounts and loan rates, including bond level information on the instruments issued by these firms, and also corporate balance sheet. And we studied the effect of we focused on the first issuance of these bonds as it provides the first important signal that these firms are able to get funding on the capital markets. And we studied the effects of this first issuance on financing conditions and performance. For this purpose, we use a matching procedure allowing to match new loans granted to issuer firms with new loans granted at the same time to ex-ante comparable non-issuer firms. What are the key questions and the key results? Firstly, we investigate whether this funding diversification helped these issuer firms in obtaining better financing conditions with banks. And this is important because indeed these firms, even if they might be able to take capital markets funding, they would still rely to some extent also on bank credit. And we do find that these firms were able to reduce their lending rates from banks by around 40 basis points, both on long-term loans and on advances. Then, as a second question, we explore how this first issuance may have changed the debt structure and the overall financial debt of these firms. And indeed, these firms were reducing the used amount of bank credit by almost 50%, while on the other hand, banks were decreasing the granted amount of credit only to a smaller extent, around 16%. So overall, these firms were using much less of the credit which was previously granted by banks. And finally, these firms were overall able, thanks to this issuance of bonds, to increase their financial debt, so their available financial resources. Then the final question is, provided that these firms have these additional financial resources, how do they use that? So we studied the ex-post performance, and we do find that these firms were able to increase their total asset and to growth, particularly via investment in fixed assets, including also intangible assets. What are the key economic channels in play? We study different potential channels. One could be the release of public information, which might come from the issuance of these bonds to the general public. A second channel, which could be related to the change in the debt seniority structure. In this case, given that loans are usually senior to bonds, if a firm reduces bank credit and issues some corporate debt, then the pre-existing bank creditors will compete to satisfy their credit claims with a smaller set of credit claims. So this would reduce exposure, risk, and that might lead also to a decrease in lending rates. And this is indeed the key explanation that we do find. Our results could be compatible also with an increase in some increase in the bargaining power of firms with respect to banks, but with some caveats due to the fact that the cost of these mini bonds could be still high. So, to conclude, in this study we find that capital markets reform, removing previous restrictions to the issuance of bonds and in general to the use of market-based finance for unlisted firms, contributed positively to improve the financing condition of these firms with banks, and in general also to improve the ex-post performance, also in terms of investment and growth. At the same time, the positive outcome of this depends also on the regulatory design, and particularly on the equilibrium or on the trade-off that you might set as a legislator between, let's say, the desirable simplification of the listing procedure for these firms, small and medium firms, and the adequate protection of investors in these financial instruments.